and good morning to all of you. This is the last monthly policy review for this year. As you have already seen, policy interest rates were reduced by 100 basis points. Therefore, the standing deposit facility rate now stands at 9%, and the standing lending facility rate stands at 10%, and the statutory reserve ratio remains unchanged. So with this, have been communicating from the beginning of the year. The policy interest rates have touched or rather reached single-digit level after 1.5 years. So the Monetary Policy Board arrived at the decision following a careful assessment of the current and expected developments, which mainly included the following. Headline inflation is projected to converge towards the target level of 5% over the medium term, and economic activity is projected to remain below par in the near to medium term, and inflation expectations remain anchored, and there's a rise in inflation in the very near term due to supply side factors, which is expected to be transitory as demand pressures remain muted. So with this, the board viewed that sufficient monetary easing has been effected thus far during the year in order to stabilize inflation over the medium term. And you can see the policy rate that we started the year above 16% level now has come down to 10% level, with a cumulative reduction of so 250 basis points in June and 200 basis points, and another 200 basis point in October, November cumulatively, so that we have created lots of space for rates to come down further. As you can see, the lending rates are adjusting downward, and we expect the trend to continue going forward along with the low policy interest rate levels at the moment. So with this, we Monetary Policy Board expects that monetary policy easing will see a pause in the near term. So given the space for market rates to adjust downward in line with the current and past monetary policy easing measures. So in response, we have seen some pickup in credit to the private sector for the last 4-5 months, but numbers are a little low at the moment, but we expect that trend to continue going forward. So latest numbers also showed month-on-month expansion in credit to the private sector, and the moderation of lending rates will help support credit growth as well as the overall rebound of domestic economic activity going forward. On the inflation front, we have seen inflation rates coming down quite sharply. At the moment, it's hovering below the target level of 5%. October inflation was 5.5, the CCPI-based headline inflation, and core inflation is also even below than that at 1.2% year on year, so reflecting subdued demand pressures. And if you see in the table some inflation, we have seen continued negative inflation. Food inflation, for instance, has been negative for last 4 months, and even transportation sector also recorded negative inflation year on year continuously for the last 4 months. Over the medium term, we expect inflation to converge towards the 5% target level. So despite the upward momentum in headline inflation in the very near term, we expect that to be transitory because this is mainly driven by supply side factors, and as demand pressures remain muted, inflation will revert to 5% level over the medium term. On the external sector, the merchandise trade deficit could expand in the coming months because exports remain moderate and the imports also will normalize. However, we see strong inflows to the current account, as we have shown in this chart on the right hand side. Our trade deficit in the first 10 months was about $4 billion, but if you take the net inflows to the current account on account of workers' remittances is above that level, 4.7 billion. In addition, we have tourism inflows, net inflows 1.5 billion, and other services recording above 1 billion. So cumulatively, we will see surplus in the current account for this year. These are the gross inflows on account of workers' remittances and tourism. We can see significant momentum in workers' remittances in the past months. So we expect further increase in November and December, reflecting sort of a seasonal pattern as well. At tourism also, we see a significant increase in arrivals. We have seen some provisional data for November, which suggests about more than 150,000 arrivals for November, and that trend will continue because of the seasonal demand as well, pattern as well. So reflecting the inflows to the domestic forex market, exchange rate remains stable. As you can see, it's hovering around 320 rupees a dollar level, which showed an appreciation thus far during the year, about 11%. So we expect further inflows to the forex market as well as to the government, with the expected finalization of the first review of the IMF EFF arrangement. So with that, more funds are due to be received by the government from multilateral lending partners. Reserves stood at 3.6 billion level as of end October. So in conclusion, so the monetary policy measures carried out thus far would help accelerate the normalization of the interest rate structure going forward. Therefore, the Monetary Policy Board stressed the need for all licensed banks to take swift measures to reduce market lending interest rates to ensure that the benefits of the series of monetary easing measures are adequately passed on to businesses and households.